In the last 33 years with Valmark, Larry has been working with and for Valmark member firms, bringing the golden rule to life. Now in his 33rd year of leading the company, it's amazing, it's simply amazing to look back on all that has been accomplished under his mentorship and leadership. Please join me in giving a warm welcome to our friend, Larry J. Rybka. Larry?
Your clients trust you. Jim Benson said, there are no professional insurance buyers. And your clients are going to act on whatever information you put in front of them. We have a firm we're talking to and may move over in the first quarter of the year. We're helping him with the life insurance case. He sent over what he's doing now. And he had these 3 lists of products that somebody ran for him. He had guaranteed UL, GUL, he had whole life, and he had IUL, and he had 4 or 5 quotes, and he just put the premiums on a page. And he's a good man who really wants to help his clients. And I called him up with here's what we would do at Valmark. And I said, you know, if you give your clients 15 choices and you outline it like this, you are like the blind leading the blind. The client is saying, what should I do? What should I do? And you don't know because somebody else ran these and you are comparing apples, oranges, and hand grenades. And to just base on premium, the client's going to pick the lowest number. And if you don't explain any more than that, the client would be way better off working with a Northwestern Mutual agent who knew what he was selling and had one choice than giving him 15 choices that you haven't thought much about. I wasn't quite that blunt, but we're not helping clients if we provide a bunch of choices where we don't have eyes wide open. So there's a time of this great, great, great opportunity, and together we can step up. When 12 of this group, 3 years ago, we published Life Insurance 10X. It was cataloging what you are doing individually, but collectively, but it was also casting a vision on the investment side of the business, the difference between a good investment plan and an okay or maybe a bad one is about this much. On the life insurance side, the difference between a good and bad recommendation is this much. There's just this tremendous, tremendous gap. And we are capable here of delivering the best life insurance solutions of anyone in the industry. So I talked a little bit about some of those things, and I won't recap them. But Caleb said, I'm excited about the life insurance part of our business. I am, because I see the opportunity of this group to lead the entire industry with what we are doing. We get stuck in what we're doing, and oftentimes we look at small ways to do things slightly better. So that's innovation. Jess showed today ways to do new things that make a big difference and deliver more value for your clients. I think with what's going on today with the insurance companies and the products that are coming out and new ways of doing things, there are going to be products that completely disrupt the old ways. And this is the group who is best capitalized when those new ways come out, whether it's fee-based life insurance, whether it's companies coming up with what we've done with policy management. We are the disruptors, and that is why we are capturing, and Libra, we're part of a pooling group. Valmark is the #1 firm in Libra. We have the largest case, largest average case. We have the highest placement ratio. We have the most repeat business. We move that business faster than anyone else. We are the disruptors. And I'd like to share across 4 things today what I'm seeing about the future, what we're doing today, and how you can be part of capitalizing in your own market of being that disruptor. I talked about yesterday this idea low interest rates. If you read everything, and actually Tom sent me some articles today, he and Bobby and I were sharing these via email, and I'll share some of those statistics. Everything going on with the life insurance companies, you've got to look at low interest. It is the elephant in the room, and anybody who's trying to address the problems and the product changes and the rating changes and the financials of life insurance companies without looking at bond rates or what's going on with mortgages is going to miss it. It's amazing that the company's pushing IUL. It's really about low interest rate. Like I said yesterday, trading clients out of 3 and 4% guarantees for a guarantee of 0, that's all about them making more money. It is the most profitable product for them, but that's driven by low interest rates. So I'm teaching an insurance class as an adjunct at John Carroll University. So Mark Armstrong and I have been developing these, and we want to bring this as a curriculum for your staff. That's the reason I agreed to do this, sir. I'm getting ready to do another one on, I guess Thursday when I get back is my next class. So I've developed some material, and this is one of those pieces of material. This pie graph represents the assets of the 100 largest life insurance companies when we aggregate them together by just assets. So we take the 100 top or largest life insurance companies in America, and 72% of their assets are in bonds, 13% are in mortgages, 3% is in cash as money comes in and out or cash equivalents, 3% in policy loans, 2% in stocks, 1% in derivatives, and 6% in other, which is probably things like home office buildings, agent balances, GA balances, various things that they may have, depreciated furniture even. And when we look at the bonds and the mortgages particularly, and we're looking at what's happened to those financial instruments in the last 7 months, it is kryptonite to life insurance companies. I'd like to go through and quantify that a little bit more. So again, some companies may hold 30-year treasuries, probably not. A little bit of treasuries on the books of life insurance companies, but this is our baseline. What's the safest investment that you can make? And what, again, has just happened since last year. If you are willing to invest for 30 years, you get a yield of 1.34% on the Treasury. But look at that drop this year. It's been going down, but it dropped to the floor. What I'd also like you to think about, this is somewhat what Tom Love and Bobby and I talked about. It's not only the absolute drop, but think of it in terms of guarantees. There was this great Society of Actuary article. There is really a question, if interest rates stay this low, is it even stressful to get to the guarantees on a 3 or 4% whole life contract? I think this is the other end of the spectrum. So AAA, US Treasuries at one end of the spectrum. This is the BAA bond, one notch above junk status. So if you're holding a BAA bond and that company gets into trouble, which is happening, and I'll talk a little bit about that, then the insurance company has to post a bunch more reserves. So this is barely investment grade, and this is about half of what the US life insurance industry holds. It's lower grade investment bonds. And again, look where we were last year at around 5%, 3.27% today. Mortgages, the second biggest holding on the balance sheets of US life insurance companies. And this is what Tom just sent me today from one of the major rating agencies. They just published a paper forecasting that the defaults on mortgages will be 50% greater than the Great Recession. This is going to take a fairly significant amount of time because the NAIC has given essentially cover to some of this. So we're not going to see it in this quarter, but 9% of the total commercial mortgages are late or there's been some variation. So 9% of the total mortgage portfolio being held by life insurance companies, there's a known problem with. If it's retail or hotel, so think about this great hotel, wonderful hotel, there's probably a commercial mortgage on this held by an insurance company. And when we're looking at retail, it's 26% delinquency on commercial mortgages, and hotels 52% delinquencies. So this is a huge, huge hit to the yield of the general account. And it's with that background now I'd like to go through and talk about the 4 elements of what we call life insurance 10X. Dan Sullivan said, all progress begins with telling the truth. It's easier to just say, oh, well, you know, the company I work with is super safe. The guy told me that they don't have any mortgage defaults. They've got all this stuff. We want to believe that stuff. But again, going back to that opening slide, our clients are trusting in us to advise them. And we have to ask the hard questions for them. We need to look at that narrow path going forward. There's great opportunities, but there's more risk. And we need to look at that. So we're going to look at what does this do to insurance companies? How can we make better selection of insurance companies? We'll talk briefly about underwriting, which again has been an incredible success for us this year. I talked to peers in the industry, and what Chris Bottaro, Eric Johnson, and their team have done this year with all of these product changes and being able to gather medical information when everyone else is struggling with this, we have a tremendous advantage. Third, product customized for the client need. This is probably the most important part, and when I talked about that potential firm sending, here's 5 IUL illustrations, here's 5 GUL illustrations, here's 5 whole life illustrations. That's not creating value. It's really helping the client understand the trade-offs of those choices. Conceivably, any of those choices might be the right one, but if we don't ask the right questions, we are just actually making a bad situation worse by sending choices that we haven't thought through. And finally, ongoing policy monitoring and management. This one, and I'm going to show you the data, makes the biggest difference. Of these 4, we can prove almost double the results of success for the firms that are doing ongoing policy monitoring and management. So let's talk a little bit about the companies. We have a number of these companies who have sponsored. Ron Herman, are you here today? Do we have Ron? The president of Equitable is here. So we weren't able to have many people, but Ron chose to thank you for coming and being with us today. I think about there's 3 kinds of companies. Now you could say for my class, as I'm teaching this, there's 2 kinds of companies. There's stock and there's mutual companies. I would really break that into 3 because I think stock companies owned by private equity represent a completely different type of ownership that, in my opinion, is not aligned with serving long-term policy interest. And we'll give you an update on Voya today as part of what I'm going to do. But I have always invested at least 100 shares. I hold 100 shares in all of the insurance companies we do business with. I started this, back pre-financial crisis. So I remember in 2007, before the financial crisis, the insurance company stocks were not doing quite as well as my other stocks, and it makes you pay a little bit of attention. So I think with the publicly held stocks, we can tell a lot about what's going on. And actually, with the publicly held companies, there's the most transparency. We know more about what is going on with those companies than any other. And it's interesting when I hear particularly mutual companies and mutual holding companies will make all kinds of statements. Oh, we own investments in this, and this is why our dividend's not going down. You never hear a stock company make those statements, because if they did, it would be called a forward-looking statement, and the people making those statements could probably find themselves very crosswise with the SEC. So we will hear different things from mutual companies and mutual holding companies that stock companies can't say. Part of the reason we even are reluctant to do these panels anymore, all the questions we really want good answers to, they can't tell us, because those would be forward-looking statements. But we can look. Every day, people are voting on, do I feel good or worse or better or worse? And I'm selling shares or buying shares in these companies. I'm putting them in my portfolio, and institutional investors are looking at these. So I'd like to show you what's happened to the strongest, best capitalized, well-run, publicly held life insurance companies from a perspective of their stock price. So if we look back 12 years ago, pre-financial crisis, and we had $1, we put $1 in the S&P 500, we put $1 into Prudential, we put $1 into Lincoln, we put $1 into Principal, we put $1 into Manulife, which is John Hancock's holding company, and we fast forward 12 years and we say, what would happen to our dollar in the S&P 500? We have $2.70. If we look at what happened, the best run life insurance company, publicly held life insurance company, is Prudential. You would have 75 cents of your dollar. If you had Lincoln, you would have about 65 cents. With John Hancock, it's 64 cents. So we can talk about the evil shareholders, with the stock companies, and they may not be as well aligned as the mutual companies, but it's not been a very good 12 years for owning stock in any companies. You think these are bad? You put $1 into Genworth, you've got 4 cents. You've got about the same amount if you invested in AIG, and that doesn't count any of the ones that are no longer around. So this is a measure of how difficult this environment, low interest rates, are for all life insurance companies. Again, some of us who have been around a while, I remember, and some people still talk about, oh, there's 2,100 life insurance companies. Update your data. And since I came in the business, that is now down to 773. You might still say, well, that's a lot. But consider Bright House probably has 5 life insurance companies that are somewhere tucked into the corporate structure. As we look at Voya, we'll see 6 or 7 of them. This also includes Gerber Life that sells policies to babies, and whoever Ed McMahon is pitching today for funeral policies. So there's really about 30, 35 insurance companies that sell products in our space, and we need to be very selective. I think, again, one of the other stupid things I hear, and I don't hear it from people here, so I can say this. Oh, we're independent. We represent 100 life insurance companies. Anybody who says that, I'm thinking, here's a real bozo who gives no thought to what they're recommending. I study this, and I think you can at best have 7, 8 choices that you've given a lot of thought to, and that you can get ongoing service, you can get results from. So it's having a select list. Now, I just look at that list. Many of you started with the companies that are on this list, and these were significant life insurance companies not going back too long. Now, again, I'm definitely proving myself to be an insurance nerd here. I do read the quarterly earning reports from the carriers we do business with. And again, more transparency with publicly held companies. They have to report their long-term earnings assumptions to shareholders under GAAP. Now you see with Equitable and Prudential in the last quarter, they reduced their long-term earnings assumptions on which they're basing their GAAP accounting. So when companies say, oh, we're going to credit, 5 or 5.5 or something like this, they are telling the SEC and their shareholders, this is the long-term rate assumption that we are counting on earning from the assets, let alone they need to make something. I look at these numbers as the more realistic benchmark for what we can expect from bonds and mortgage-based products. And again, many will come down. We're going to talk about Voya, but you could be pretty sure Voya wants to get all this insurance off of its books before it changes the assumption, because it would crush that quarter's or next year's earnings assumptions. So a bright spot. We have this thing that we call our star ratings. We meet quarterly. We're looking at all of this information and more with the companies that we do business with to really give a lot of thought, because this is one of the things you ask of us. The U.S. life insurance industry, the stronger capitalized companies, raised more year to date than they have in the last 2 years, but it is entirely focused in a small group of well-capitalized life insurance companies. And no press releases on any of these. I found these mainly through AM Best when surplus notes were issued. So they weren't making a big deal. When Prudential said we raised $1.5 billion of capital in surplus notes, there wasn't much a press release on this. But this is evidence that institutional investors have confidence in these companies' balance sheets and are willing to give them money for 20, 30, or 40 years on very, very favorable terms. Now, I put one down at the bottom here, and I don't think this is terrible terms, but if we look at Bright House, 10-year note at 5.625, and you compare that with other 10-year money, that additional interest rate that they are being charged is a risk premium that institutional investors could allocate money to. Either they could give the money to Manulife at 2.2%, get a 2.2% yield on that same duration, or they could allocate it to Bright House, and they want more money if they're going to allocate it to Bright House. So these are the kind of things that we look at because I think the rating agencies, it's a completely flawed tool. If we're looking at a Comdex, if we're looking at Fitch, if we're looking at AM Best, and we'll talk about Voya, and they give one set of ratings today because it's owned by Voya, and everybody knows that they're trying to dump this off to a private equity company, and the rating agencies don't change the ratings until it's actually dumped off. What good are ratings? What good are ratings if some of you recommended MetLife as the largest investment or insurance company in America, and then 5 years later you find out, oh, well, that was MetInvestors Life. They could just pick up all the things they didn't want and put it into a box called Bright House with now significantly lower ratings. So ratings, it may sound good. Look, I've done this Comdex, and here's the strong companies. But in my experience, many of the companies that are gone were AAA rated. Ratings don't tell us anything about the financial strength of the companies that we are recommending. So let's talk a little bit about, I said I think there's 3 forms of life insurance ownership. One is mutual, one is stock, and one is private equity. For 10 years we have been talking about this I hate, private equity might be a good place to invest. We're happy for some people, but I hate it as a form of ownership for life insurance because there is not long-term alignment. And I also think the temptation to try to take out as much money as possible in the short term is inconsistent with the long-term guarantees and promises that insurance companies represent. So last year in December, Voya announced that it was spinning off all of its U.S. life insurance operations to a private equity firm called Resolution. And we had to wait. We felt that this is something we should do something about. If we really say we want to act in clients' best interest, if we really want to be on the side of clients, it can't just be when we sell something. I really felt, and I went to our management group and I said, I think we need to devote resources. We were the first, and at this point, the only organization that said we need to stand up for policyholders. So we allocated $50,000 to hire counsel to see what, number one, to give you information, but now to fight this because I think it's the right thing to do. So under the Freedom of Information Act, we found that it is Colorado that has to approve this transaction. There are a number of non-public documents, 200 pages filed, but all of the key elements were non-public. So under the Freedom of Information Act, we got those documents, and I'm going to share some of that with you. The day the Colorado commissioner released us those documents, Doug and I got a call from the vice chairman of Resolution wanting to have a conference call with us and explain to us, once these documents came out, they wanted to have a call with us. Now, I will grant they have a very, very impressive team, including the former Nebraska insurance commissioner who approved the Lincoln benefit transaction, which Resolution also bought. Impressive financial people. But for sure, the ratings will be much lower. We don't know how much lower because the ratings agencies won't tell us until it's done, and Resolution will probably not pay for any ratings because the companies pay for the ratings. That tells you something about why the ratings are worthless. I'll show you a diagram of what we see happening with this, but it's essentially hard assets being substituted for temporary capital. And I really question the sufficiency of the reserves for some of the long-term promises. For sure, non-guaranteed elements are going to continue to change to the client's detriment. I'm also fighting this because precedent. If they can get away with this, this will be so much bigger than anyone done before. We could expect other companies to think about this, dumping either parts of businesses that they don't find profitable anymore. So this is a fight worth fighting. So we talked a little bit about what a bad investment a share of Prudential, Lincoln, Principal would be for you as a shareholder. I'm going to show you a really, really bad investment. ING started buying insurance companies in the U.S. in 1977 with Security Life of Denver. I looked and looked, and I couldn't find the purchase price for that one. But I did find in 1997 they bought Equitable of Iowa for $2.7 billion. In 2000, they bought ReliaStar for $6.1 billion. And they also bought Aetna Life for $7.7 billion. Now, ING got into a liquidity crunch that the main company or the holding company during the last financial crisis and borrowed $10 billion of euros from the Dutch government. And they needed to repay that. So part of that repayment involved doing a spin-off IPO of the U.S. life insurance companies under the new brand of Voya. So those proceeds from the IPO went back to the Dutch government. They didn't go into Voya. In 2018, Voya announced we're not going to sell any more life insurance. Another good clue that bad things were going to happen. The only thing that Voya was selling its last 3 years in the life insurance business was index life, the one product where they could change the most at the disadvantage of policyholders. Now, you think about acting in clients' best interest. It'd be pretty hard to say, boy, I really wanted to sell that last ING Index UL right before they announced, I want to get the last application in. That would be a tough one to meet a best interest test on. So in December, Voya announced this sale to Resolution Life for $1.2 billion. Now, I want you to think about that. $16 billion invested 20 years ago to return $1.2 billion. Now, I know they have all these commercials about orange money. I think if we said, well, let's see how Voya's done in the past with its own investments, not so well. I wouldn't really trust what their investment acumen is. So let's look at one of the things that we found in our Freedom of Information Act filing. It was, like I said, 200 pages of very complex transaction, but here is the diagram. The blue companies are what they're buying. The orange structure above it is the capital structure to acquire them. And when we say that that Voya is getting $1.2 billion, of that $1.2 billion, they are investing $300 million in this new structure that is owned by Resolution. So they are investing their proceeds in this new structure because it is more profitable to own the insurance company through this private equity company than it is to keep it. I really think at its core, and this is why today was the day, or yesterday was the day, we had to choose to file in opposition. And Valmark is filing in opposition to this transaction. I will probably end up testifying on this because the people in this room, we have 1,000 people who at various points in time own just ING life insurance products, whether it was ReliaStar, Security Life of Denver, and variable annuities. It's the right thing to do. It's bringing the golden rule to life. It's being an advocate for clients. And this is the separation. When we came into this business, we could feel very good about representing the companies we sold. Today, we have to choose, and we are choosing to side with policyholders and protecting their interests. So Tom put together a great white paper on choosing companies, our thoughts. You can brand this, and I think it's refreshing. I've used the metaphor. Many of you are both in the investment and insurance business. There's not a single firm here that has a serious investment practice that when the client comes in, they'd say, well, you know, I haven't given much thought to how we're going to allocate your assets. I'll just go look at all the mutual funds, I'll look at all the ETFs, and I'll see who has the highest yield today, and we'll pick that one. We have a select list. We allocate 5% of their portfolio to a mutual fund or ETF after giving it a lot of thought. Life insurance is 100% allocation, especially if it is general account. If there should be one place where we give the most thought as to who we're going to do business with, it should be life insurance. So a matter of choice white paper, it's a couple years old, but it's more important than ever. And nothing has really changed. So that second circle, underwriting advocacy, our pure system. Again, rather than me just promote it, it's a time to applaud what Chris and Eric have done. I mean, for this group collectively to be ahead 65% of last year with our best year ever and the prospect of an incredible fourth quarter. Chris, Eric, how about if we give them a round of applause? Now, Chris has done sessions on this. I'm not going to repeat this, but just the incredible creative ways that Chris and his team are finding ways to get authorization for medical portals, to get exceptions using the Pure system has made this possible. And there's never been more roadblocks or obstacles. And to get that kind of results in a year where everything is changing. I think the big issue is premium limits. And again, if you want guarantees, we are finding premium limits. But there are no limits when we're looking at variable products with lesser guarantees. That door is wide open. So if you have big 1035s and you want to get transactions done, the variable lane of the highway is the only one that is wide open. Companies today, I think about BOLI. There are no companies who want to do a BOLI transaction because no sane insurance company would want to get $40, $50 million to put into their general account today at this point in time. We went through where would they put it? What does it get invested in? So I think an area of these four circles that we probably have talked the most about and have built the most tools has to do with a product that is customized for the client's needs. Now, some of you operate in the state of New York. I don't think we have anybody here today from New Jersey Life and Casualty. I know Andy Villa, Randy Schuster. So last year, we were looking at this requirement in New York of a best interest test. And it's not that there's a best product or it's not disclosure. It's just making sure that this client with these goals, we gather this information and we make a recommendation. It's all triggered by the recommendation and that it's right for them. It accomplishes their goals. It should be basic. Now, in the other 49 states, you can use the Life Insurance Design Questionnaire as an optional tool. That is our tool in the state of New York. And again, it's given our firms an advantage. Rather than have a prudential form and a nationwide process and having different lanes, we can use one lane, the Life Insurance Design Questionnaire, to gather that data, document a recommendation, and all of our carriers have accepted this for compliance with 187, giving us a tremendous advantage. So as we think about that, Bobby Samuelson said, every product tells a story. And I think it's our job, if we want to be best in the world at this, to make sure we tell the story correctly. And sometimes we get confused. So you think about universal life, variable adjustable life, allowed the client to choose the premium. And we probably could have done a better job of saying, yes, we can pay less in premium. Yes, you can skip this, but let's talk about the consequences of what happens if interest rates go down or what it costs you to catch up if you skip that premium. You don't just get to skip it and keep all the benefits because there's two sides to this story. Bobby talked about how variable is the product really of the future. And we also have an investment component. I thought the idea he had yesterday about choosing low-cost funds and actually getting some of that money back, when we show a variable illustration with an average rate, which is the default, we're actually showing the client considerably more cost than they may actually be incurring if we follow that strategy. Now, Universal Life with secondary guarantees had been the biggest selling product in Valmark for really about the last 15 years. It was a simple story in terms of this is the price. If you paid the premium on time, the insurance company can't change it. The consumer understood it. It was easier to compare and say these are all guaranteed prices. But one thing we forgot about it almost becomes like whole life. You have no flexibility. If you don't pay the premium, you lose almost the entire part of the value equation. So they might even call those products flexible universal life, but it's anything but flexible in operation. So there's a give up for that. Little or no cash value, complete lack of flexibility. And now, currently in the death benefit market, it is the VUL hybrids. I'll show you the breakout of your sales year to date, but that is far and away the greatest proportion of the products that you are selling as a group. If you're teaching college students, now these are finance students, I'm not teaching art majors. They've had basic finance, they had some taxation, but trying to explain life insurance for the first time to people, young, bright people who are seeing this for the first time, had to think of a metaphor. And interest rates are what fuels the products, or the accumulation of cash value is what fuels the products we sell. And what kind of interest rates are we going to have? It's always been projections, but look at the difference, and this is just a simple compounding or solving for a payment, like a mortgage. If we have an 8% rate and we've got 40 years, it's a little under $4,000 to accumulate $1 million of death benefit. Now, your basic intuition would be, well, if we cut that in half, then it should be double. But because of compounding, it doesn't double, it goes to $10,500. And this is what has been happening with life insurance, but it's actually worse, because on a lot of these products, there's a 3% guarantee, and as we go from 4 to 3, we're not losing 1/4, we're losing all of the dividend that makes this go. So general account products become more and more sensitive the closer we get to that guaranteed rate. Now, we show illustrations to our clients. We'll often point to the premium, and we, I think, sometimes wrongly equate that with the cost. This is just the amount of jet fuel we're putting into the plane. It's not the cost. We'll have to see. It's a long flight. How many more times will we need to stop? Is there enough to get the plane there without putting additional money in? And we'll look at benefits. But we really need to look underneath those products and say, what is underneath them? What are the investments that the insurance company's holding? And we just talked about, with general account, it's 85 to 90% bonds, mortgages, and other fixed instruments. So to expect any general account product to do better than the yield on those instruments that we talked about is just setting ourselves, our clients, and our reputation up for disappointment. And that's why, again, I said it yesterday on the breakout, in 1996, Dad and I decided to start Valmark as a broker-dealer. It was an all-in bet, because we thought then, and I believe even more fervently now, the future of high-end life insurance is almost all variable. It gives your clients a better upside because equities have traditionally outperformed bonds over any measurable period. But perhaps most important, as I think about if we are not able to block resolution from acquiring Voya, the best protected policyholders will be those with separate accounts. Tom Love has just done some incredible work. These are also contracts. We look at illustrations, but we need to pay attention to the language. We need to say what happens with that contract. What are my rights? And I think, again, you look at IUL, you look at these illustrations, you need to read the contract, because that's what tells you you're really going to get. Now, how can you put this in front of your clients in a friendly way, or advisors, and help them explain this? We've created a whole bunch of tools that are all compliance approved that help you to explain this. Now, you've probably seen this material before, but I'll show it to you again. It's part of the LA 360 blueprint. It's not uncommon for our teams that design your life products for us to get a request, more from newer firms than from firms more experienced. Larry, let's run the variable at 7, and we'll run the UL at its current rate. Or we'll run a whole life contract at the current dividend scale. And we could show statistically the chance of getting 7 in equities over a long period of time is 100%. But when we run that UL at the current rate, there might only be a 25 or 30% chance of the client getting that. And we've said, why not just turn this around? And we've got, again, the data, what underlies these products. And if you want a 90% confidence, an 80% confidence, 100% confidence, let's do that uniformly across product types. Let's not handicap, or the worst of all is, I'm really conservative. We'll run the variable at 7, and we'll run this IUL thing at, with all its multipliers, bonuses, there's 0 chance the client's ever going to get that. And it's not an apples to apples comparison. It is misleading. You're not helping a client when we do that kind of comparison. It's actually leading them the wrong direction. That client's got is blindfolded and following the advisor who does that right off the edge of a cliff. And I suggested one way to quantify some of this is to look at products and say, let's look at 3 products. Let's look at a variable product, let's look at a whole life contract, and let's look at an IUL contract. And then let's measure how much of, not what the market might change, because markets will do what they're going to do, but how much discretion is in the hands of the insurance company to change the deal for our clients. And again, this will vary based on product, how much premium you put in. The more premium you put in, the less that can be changed. But with the same premium going into 3 products, with the same amount of death benefit, it was 19% with the variable contract. So if the day after they buy it, Resolution acquires this company and turns all the dials against the consumer, it's 19%. With the whole life contract, it was 38%. And with the IUL product, it was 78%. So that's one way of looking at it. I don't know, I think some of you follow me on LinkedIn, and I've been doing more LinkedIn posts. I've been trying to keep them shorter. I talked about, these look like 2 fast cars, right? They're both white. They both would probably turn your head. Now, I'm kind of I like cars as well as life insurance. So anybody know what that car on the bottom is? It's the brand new Corvette. It's the 2020 Corvette. Has a V8 engine in it. Motor Trend Car of the Year, wonderful car. If you want to buy one, get in line. It's 12 months from the time you give them the deposit. They've sold out the entire production for the next 12 months. Now that car on top will cost you a lot less than the Corvette. Looks pretty cool. Anybody know what that is? It's a kit car with the parts purchased in Bulgaria, bolted onto a Fiero chassis. I think when we just look at illustrations, we're looking at the outside. Boy, these look like fast white cars. The variable product has a V8 engine in it. You can get it serviced at your local dealer. That kit car from Bulgaria will probably ultimately be serviced by a private equity company with a 4-cylinder engine on a 20-year-old chassis. So, year to date, I said I'd share with you what the breakouts look like. Again, phenomenal year for this group. You can sell anything with a large number of quality carriers. And When we take out term insurance, because again, those clients have decided I'm covering this need, that would be the majority of our policies, but this is measuring by premium. So 11% of the premium you write is term insurance. 11% is UL, mostly in the form of guaranteed UL. That 4% of IUL. Securian has a great guaranteed product on an IUL chassis. I almost consider that a form of GUL. But 83% of the permanent policy needs are on a variable chassis. Bobby talked about how this group is better prepared for the changes ahead than anybody in the industry. So let's go to the final component. We got companies, we've got underwriting, we've got designing the product for the client's needs and taking into account realistic economic assumptions. And the final part is ongoing policy management. We were the first in the industry 5 years ago to launch a separately capitalized policy management company. Again, had some discussion internally because we are just barely this year covering our cost of adding that. But it's a belief in the future. It's really keeping promises. It's recognizing you are all really good at what you do. Some of you are great or have one or two people who are great at policy management. But to keep this going past you, it's not going to happen. If you lose that one key person who knows how all these things work, and I think we have 276 different types of products spread over more than 30 insurance companies. It requires scale, it requires expertise to do this well. And that is a great evidence of our belief and commitment to helping you be the best in the world at it. Michael Miklich is here. If you're not using this and you want to be one of the best life insurance, you want to be a life insurance superhero, you want to be the best in your market and you are not doing this, you are not the best. You are missing the most important component of keeping promises to your policyholders. So I'd like to prove to you why, now again, looking back a couple years at the results. So we had two firms bring on a large block of almost 1,000 policies last year. And again, these are good, some of our best offices. They sold quality companies, they designed them well, we got great underwriting. All of these companies are still in business. It's not private equity owned, Global Atlantic or stuff. These are good companies. And 44% of the policies were on track. 37%, it was a great product, but maybe less came over in 1035 than scheduled. The client missed a premium. The insurance company lowered the interest rate. There was a wrong allocation. I was the first customer. One of my policies had Mary Rybka as beneficiary. There is no Mary Rybka, but if I had died with that on the insurance company's system, it would have probably locked up that policy for months or maybe a year while they looked for Mary Rybka. So, needs recalibration. About 17%, if we could get underwriting, would justify a replacement. Let's look at policies that had been a year or more in the policy management company. Almost double the number on track. Now again, you can tell the client, hey, we bought this 10 years ago, interest rates have come down from 7.5 to 3.5. You need to put more money into this. We're never going to get that recalibrate to zero, but we're on record telling the client that they need to do something if they want to keep their insurance. We're delivering the news to those policyholders. So double the results. This we can prove. And now Michael has developed some wonderful metrics about which type of products, which companies are the most on track. I think that data is going to be tremendously valuable as we go forward. A simple 2-page report with recommendations. They get you the forms. This is the best way to move to 10X. So we started yesterday and today. Caleb talked about bring the golden rule to life can really mean a couple things. It can mean to everything we do and to the life we live and creating, helping our clients live better lives, but it can also mean in an industry that needs guidance the most, in a place where we can stand out and really be better than anybody in our market. Bringing the golden rule means, is this a recommendation we would implement ourselves? Looking at companies that are going to be long-term aligned with policyholders. Maximizing underwriting advocacy. Again, that's the one place we really can reduce cost. It's by negotiating for the most favorable risk classification. And again, I think those of you who have worked with us for years, we are best in the world at doing this. And it means 1 or 2 or maybe even 3 more transactions if we can get that category for you. Designing products with real-world assumptions. You know, it's not selling a white car that the client thinks has this huge engine in and they find out it's a 20-year-old Fiero once they buy it. If they want a 4-cylinder engine, let's call it a 4-cylinder engine. Nothing wrong with that. But let's be truthful and let's, number one, have our eyes wide open. Ask the hard questions. Has to be accepting lower yields in the general account. There are no good recommendations if we don't accept that. It's likely to be on a variable chassis. Using tools consistently to help the clients make informed decisions, not just bringing out, here's 5 prices. Use a tool like the Life Insurance Design Questionnaire and LA360. Explain how the contract works. That's really what New York 187 is about. Look, if we're doing a 1035 and we're showing the client one of these VUL hybrids from Prudential, Lincoln, Nationwide, whoever, look, the great thing about this recommendation is these are the guarantees. I also want to point out, this is the hard part, there's $200,000 less liquidity in this, and you have less flexibility ongoing. We need to be the ones, if we're really going to be professionals, to help the client make an informed decision. And then finally, providing ongoing policy monitoring and management. It's a narrow path, and there's never been a time when clients need true professionals that have their eyes wide open to guide your clients with the best advice to a bright future. Thank you.